As Treasury Secretary Janet Yellen proudly announced a soft landing for the US economy, the disconnect between the government's optimistic narrative and the grim reality felt by everyday Americans is stark. Despite the rosy picture painted by official reports, a prevailing sense of economic gloom persists among the majority of the population. Thousands of bank branches are shutting their doors and major retailers are rapidly closing down stores. The government's optimistic report does not reflect the pressures facing America's economy. On January 5th, Treasury Secretary Janet Yellen announced that the US economy had successfully achieved a sought-after soft landing, an uncommon occurrence where high inflation is controlled without causing significant harm to the labor market. Yellen expressed her optimism, stating, "What we're seeing now, I think we can describe as a soft landing, and my hope is that it will continue." This declaration followed a report from the Labor Department revealing stronger than expected job gains in December. According to the report, American employers added 216,000 jobs in December 2023, an increase from the 199,000 added in November. The unemployment rate remained steady at 3.7%. Additionally, average hourly earnings rose by 0.4% on a monthly basis and 4.1% year-on-year. Yellen, in an interview with CNN, remarked, "American workers are getting ahead, and the progress for middle-income families is very noticeable." However, despite these positive economic indicators, a significant portion of Americans remains pessimistic about the economy, as revealed by various polls and surveys. In a poll conducted by the Associated Press Nork Center for Public Affairs Research, approximately three-quarters of respondents described the economy as poor, with two-thirds noting an increase in their expenses and only one-quarter reporting an increase in income. The apparent disconnect between positive economic metrics and public sentiment can be attributed to several factors, but economists increasingly highlight one in particular: the lingering financial and psychological impact of the most significant bout of inflation in 4 decades. Despite a gradual decrease in inflation over the past year, the costs of many goods and services remain substantially higher than they were just 3 years ago. While the rate of inflation is slowing, the majority of prices remain elevated and continue to rise. Lisa Cook, a member of the Federal Reserve's Board of Governors, underscored this ongoing challenge in recent remarks at Duke University. "Most Americans," Cook said, "are not just looking for disinflation, a slowdown in price increases. They're looking for deflation. They want these prices to be back where they were before the pandemic." This holds particularly true for essential goods and services that form a significant part of Americans' regular expenditures, staples like bread, beef, and other groceries, as well as costs associated with apartment rents and utilities. On a weekly or monthly basis, consumers are consistently confronted with the noticeable increase in these prices. Deflation, characterized by a widespread decrease in prices, tends to make both individuals and businesses hesitant to spend, making it an undesirable economic condition. Economists emphasize that the preferred scenario is for wages to outpace price increases, ensuring that consumers still enjoy financial gains. Assessing how inflation-adjusted incomes have navigated since the onset of the pandemic proves to be a complex task, given the diverse experiences of approximately 160 million Americans. According to calculations by Wendy Edelberg, a senior fellow at the Brookings Institution, median weekly earnings, representative of those in the middle of the income distribution, had only risen at a meager 0.2% annual rate from the final quarter of 2019 through the second quarter of 2023 when adjusted for inflation. This minimal increase has left a substantial number of Americans feeling as though they have made minimal financial progress. The impact of the economic downturn is not limited to American consumers alone. Even banks are grappling with significant challenges in the current economic landscape. Banking deserts are springing up for decades. The presence of bank branches has been a staple on America's main streets, often constructed with elegant stone facades resembling miniature Greek temples. However, a noticeable shift is underway as the nation's largest banks appear to be rapidly closing these traditional branches. Over the past 12 months, Wells Fargo has shuttered 258 branches, JP Morgan Chase closed 165, and Bank of America nearly 100, as reported by S&P Global Market Intelligence. Consequently, the total number of bank branches in the US has diminished by over 1/5, now standing at 78,000, down from nearly 100,000 in 2009. Soft profits and a strategy of aggressive cost-cutting indicate that more Americans are likely to witness the closure of their local bank branches in 2024, according to Nathan Stovall, head of financial institutions research at S&P Global Market Intelligence. Stovall notes, banks have recognized that their physical footprint does not need to be as large today. As revenue pressures persist, banks likely will continue to shrink branch networks. The last time the number of physical bank locations increased was in 2009. Since then, there has been a consistent decline in the total number of branches, with a record 2,126 net closures in the first year of the COVID pandemic in 2020. In 2021, the record was surpassed again, with net closures growing by a remarkable 38% to just under 3,000, as per data from S&P Global Market Intelligence. Several banks have already declared their plans for further reductions, with PNC set to close at least 19 branches across multiple states by February, and Huntington Bank announcing the intended closure of 34 branches by the end of March. Even smaller institutions have unveiled plans to trim their physical locations. Certain sectors, like supermarkets, are experiencing an acceleration in branch closures, closing 7 times faster than the overall trend. Nathan Stovall comments on this shift, stating, "In-store branches have fallen out of favor at many banks. We've seen banks look to shrink their branch networks, with a focus on cutting less profitable branches that generate less customer traffic. Bank executives are increasingly critical of the efficiency of their workforce, structures, and processes." Wells Fargo CEO Charlie Scharf recently acknowledged the need for radical efficiency improvements, stating, "This company is not efficient, period. End of story." The closure of branches raises concerns about the number of people left without bank services, and the consolidation is leading to the emergence of banking deserts, where communities lack access to a bank or credit union within a 10-mile radius. Branch cuts also inadvertently mean that thousands of jobs are being lost. In 2023, global banks executed a significant downsizing, eliminating over 60,000 jobs, a notable shift that ranks among the most substantial annual cuts since the financial crisis. This move represents a reversal of the hiring trend observed during the post-COVID-19 pandemic recovery. Among the world's top 20 banks, at least 61,905 jobs were slashed in 2023, as per calculations by the Financial Times. This figure, although substantial, falls short of the over 140,000 jobs cut by these same institutions during the global financial crisis of 2007-08. Wells Fargo emerged as the second largest job cutter in 2023, announcing a reduction of 12,000 positions, bringing its global headcount to 230,000. The bank disclosed spending $186 million on severance costs in the third quarter alone, resulting in the elimination of 7,000 jobs. Other major contributors to the job cuts included Citigroup, 5,000 jobs, Morgan Stanley, 4,800, Bank of America, 4,000, Goldman Sachs, 3,200, and JP Morgan Chase, 1,000. Collectively, the prominent Wall Street banks streamlined their workforce by at least 30,000 in 2023. In addition to workforce reductions, U.S. banks are tightening lending standards and reducing loans to businesses, potentially signaling a slowdown in economic growth. The volume of commercial and industrial loans dropped by about 0.2% in September, marking the 6th consecutive month of decline based on the Federal Reserve's H8 data. This prolonged contraction in lending has raised concerns among market observers about the potential economic deceleration sought by the Federal Reserve to curb inflation, possibly leading to adverse consequences. The diminishing borrowing activity reflects declining business investments and hiring, both of which have implications for overall